India India's persistence of negative wholesale price inflation, even as selected food prices show intermittent increases, reveal a far more complex and instructive economic reality than the comforting headline of inflation under control. Wholesale price index deflation is not merely a statistical curiosity or a technical footnote in macroeconomic reporting. It is a single embedded deep within the it is a signal embedded deep within the production and pricing structure of the economy. To understand what is unfolding, one must move beyond surface interpretations and examine the interaction between demand, pricing power, sectoral stress, and policy response. When wholesale inflation remains negative for consecutive months, it doesn't simply indicate cheap prices. It indicates an economy where producers are constrained in their ability to raise prices, even when costs or risks would be ordinarily justify doing so. Wholesale inflation, unlike consumer inflation, captures the price environment faced by producers, manufacturers, and bulk traders. It reflects conditions before goods reach the consumer, before taxes, retail margins, and distribution markups are added. As such, it is a closer proxy for industrial health, cost transmission, and investment incentives. A negative WPI suggests that producers are either facing falling input prices, weakening demand, or competitive pressure so intense that margins must be sacrificed to maintain volume. In India's case, the persistence of WPI deflation indicates that all three factors are operating simultaneously, reinforcing one another in a way that produces stability without momentum. A major drive of this deflationary environment has been the sustained softness in energy and commodity prices. Crude oil, natural gas, mineral oils, electricity, and the basic metals all registered year-on-year price declines. These components carry substantial weight in the wholesale index and exert a powerful dampening effect on overall inflation. At one level, this appears beneficial as it reduces cost-push inflation and eases pressure on firms and policymakers alike. However, at a deeper level, it signals a global and domestic demand environment that lacks the intensity required to generate upward pricing pressure. Energy markets respond not only to supply conditions but also to expectations of industrial activity. Persistently subdued prices indicate that producers and traders do not anticipate a surge in demand significant enough to tighten markets. The manufacturing sector provides perhaps the clearest window into the structural meaning of negative wholesale inflation. Manufactured goods inflation hovering just above zero is not consistent with an economy experiences broad-based expansion. In periods of strong growth, manufacturers typically enjoy sufficient demand elasticity to pass on cost increases and even expand margins. When manufactured inflation remains muted, it implies excess capacity, competitive discounting, and inventory pressure. Firms are producing but not at utilization rates that allow confident pricing setting. Instead, prices are treated as strategic variables to protect market share rather than reflections of underlying demand strength. The environment of weak pricing power leads to margin compression, a phenomenon with far reaching consequences. When margins are squeezed, firms reduce capital expenditure, slow hiring, and become more risk averse. Investment decisions shift from expansion to preservation. Over time, this dampens productivity growth and reinforces the very demand weakness that caused margin compression in the first place. Thus, wholesale deflation is not a neutral state, it can become a self reinforcing equilibrium where low inflation coexists with restrained ambition. Food deflation, which has persisted for several months despite occasional seasonal upticks, adds another critical layer to this analysis. While falling food prices are often celebrated for easing consumer burdens, they impose several strain on agricultural producers. Prolonged food deflation erodes farm incomes, weakens rural demand, and reduces the capacity of a large segment of the population to participate meaningfully in consumption growth. Rural distress doesn't always manifest immediately in headline GDP numbers, but it gradually undermines the foundation of mass demand. An economy where food prices remain depressed for extended periods risks creating a structural imbalance between urban consumption resilience and rural stagnation. The divergence between wholesale and retail inflation further illuminates the nature of the current macroeconomic phase. Consumer price index inflation has edged up modestly, driven primarily by food prices, while wholesale inflation remains negative. This gap indicates that producers are unable to pass cost pressures forward to consumers. Instead, they absorb them internally, compressing margins. From a political standpoint, this configuration is convenient as consumers do not experience high inflation. From an economic standpoint, however, it reflects a distribution of stress away from households and towards producers, a distribution that cannot be sustained indefinitely without affecting investments and employment. Monetary policy had responded rationally to this environment. The Reserve Bank of India has taken advantage of subdued inflation to reduce interest rates significantly, aiming to stimulate demand and ease financial conditions. These cuts were not signals of exuberant confidence but acts of preemptive stabilization. By lowering borrowing costs, the central bank sought to prevent weakening pricing power from translating into a broader slowdown. However, monetary policy has diminishing effectiveness in an environment where structural constraints rather than financial costs limit demand. Rates cut can support balance sheets and improve liquidity, but they cannot on their own restore pricing power or generate rural income growth. What emerges from this analysis is an economy characterized by controlled stability rather than dynamic expansion. Inflation is low not because demand is roaring, but because multiple forces are restraining price formation across sectors. This stability has value. It anchors expectations, protects purchasing power, and reduces macroeconomic volatility. Yet it also carries opportunity costs. Without pricing power, firms hesitate to invest aggressively. Without income growth, consumption remains selective. Without broad-based demand, growth becomes uneven and fragile. Danger lies not in negative wholesale inflation itself, but in complacency towards its implications. Treating deflation as an unqualified success risks growth, ignoring the underlying constraints it reveals. Sustainable growth requires more than low inflation. It requires confidence among producers that demand will support higher prices, justify investment, and reward innovation. Until that confidence returns, negative wholesale inflation will remain less a badge of victory, but a more diagnostic indicator of an economy operating below its potential. In this sense, India's current inflation landscape should be read as a transitional phase rather than a destination. It reflects an economy that has avoided overheating and preserved stability, but has not yet unlocked the momentum needed for robust, self sustaining expansions. The challenge ahead is not to celebrate low inflation, but to convert stability into strength, ensuring that price signals once again reflect healthy demand rather than suppressed expectations.